Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, August 7th, 2024. Hope you're having a fantastical day out there. Pardon my tardiness. I had to run to Lowe's, my favorite home improvement warehouse, to pick up some more spray texture because I ran out. So I'd like to get the wall painted before tomorrow, or by the end of tomorrow. So anyway, I hope you're having a fantastical day out there. It's kind of gloomy here in Colorado, but we will take the cooler weather and the rain. So it's putting out those forest fires, which we are very happy about here. And Astros are playing right now. So if you are an Astros fan, they are up 5-3, and we're now heading to the bottom of the seventh. And we were up 5-0 earlier, but you know, it's the Astros. They can't ever make anything easy. So, all right. If you could, before we get started, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. Boy, the markets were weird today. They were in a happy mood this morning and then not a happy mood this afternoon. So Dow Jones took a dump, actually all three indices took a dump this afternoon. Dow Jones was down 0.6%. It was the first one to head into the red, down 234 points, closed at 38,763. The S&P 500 down 0.77%, 40 points, closed at 51.99. NASDAQ down 1.03%, 167 points, closed at 16,198. So if we go over here to the chart, so here's the daily, here's today's chart for the Dow. You can see opened up, it was up, what was that, about more than 1%? And then something happened, just around, I guess, 11:30 noonish time Eastern, it just started trending down. And, that's where we wound up. Let's go to the S&P 500. Yeah, about the same time. And same thing with the NASDAQ. So it looks like just we're not able to keep up with the, the momentum everyone was hoping would stay in the market. I guess a lot of those, people buying the dip could only do it for so long. All right, getting back into it. The VIX is flat right now. It's at 2785. Canada down 0.45. Brazil up 0.89. And Mexico up 0.54. Germany up 1.5%. The UK up 1.75%. France up 1.91%. The Netherlands up 2.24%. Spain up 2.01%. Italy up 2.33%. Switzerland up 2.9%. And Portugal up 1.85%. So pretty good day across Europe. In the Russian exchanges, MOEX up 1.51 and the RTSI up 0.58. And the overnights, the Nikkei in Japan was up 2.51%, Australia up 0.25%, New Zealand up 0.82. In China, the Shanghai was up 0.09, Shenzhen component down 0.17, China A50 up 0.13, DJ Shanghai up 0.05, Hang Seng up 1.38%, and the Taiwan weighted up 3.87%. That's a big jump. All righty, so that is that for the markets for today. Let's get into the market recap here. S&P 500 closes lower as rebound fades. The S&P 500 reversed earlier gains to close lower on Wednesday, primarily driven by a slump in super microcomputer, which affected chip stocks and weighed on the broader market. Super microcomputer stock plummeted 20% after missing earnings estimates for the June quarter. That'd be the second quarter, I imagine. The company's inability to meet the demand for liquid-cooled systems contributed to the miss, sparking concerns about the AI industry's demand. This led to a sell-off in chip stocks with NVIDIA, Broadcom, and Wolfspeed among the major decliners. Weaker Treasury auction and rising yield. A weaker than expected 10-year Treasury auction pushed yields higher. The U.S. government sold $42 billion of 10-year Treasuries at a higher than anticipated yield of 3.96%, causing the 10-year Treasury yield to climb 6 basis points to 3.951%. Energy stocks are shining. Energy stocks provided a bright spot, supported by a significant jump in oil prices after U.S. crude stocks fell more than expected. The Energy and Information Administration reported a 3.7 million barrel decline in crude stocks for the week ending August 2nd. Targa Resources, Williams Company, and Devon Energy saw notable gains, with Devon Energy also reporting strong quarterly results. Mixed earnings reactions. Disney saw a 4% drop in its stock after reporting a decline in profits from its parks and consumer products segment despite a profitable quarter for its streaming services. Shopify soared nearly 18% on better than expected quarterly revenue, driven by its AI-powered tools attracting more merchants. Conversely, Airbnb fell 13% after forecasting lower than expected third quarter revenue and a warning of shorter bookings windows due to economic uncertainty. Market resilience amid economic concerns. Despite the recession fears and negative market sentiment, S&P 500 earnings have shown resilience. Citi strategists maintain that their $250 earnings per share forecast for the S&P 500 in 2024, slightly higher than the consensus of $243. Goldman Sachs noted increased market stress, but no severe disruptions warranting policy intervention. So, all right. So that's all the interesting stuff in the news today. So see, we're going to get out number 2 here in the bottom of the 7th. Good news there. Next up, some not so good news. This comes via the Newswire and Investopedia. U.S. credit card delinquency rates hit levels not seen in 12 years. In the second quarter, U.S. consumers accumulated debt at a slower rate, yet delinquencies on credit card payments reached their highest levels in over a decade, as reported by the Federal Reserve Bank of New York's quarterly report on household debt and credit. Specifically, 10.93% of credit card accounts were delinquent by more than 90 days. That is not good. Because typically when you're in the collections and recovery world at a bank, usually the first 2 months, they call that like early stage, front end. And usually they don't close your accounts when you're 1 to 2 months late. You go more than you go 60 days late, you're 2 billing cycles or more behind. Your account usually gets closed, and with a never reopen this one ever again. I forget was that like a R7, R9? I forget the closing codes on those things. It's been almost 2 decades since I've done that. But anyways, you go further than that. You're in the mid stage of collections. The 3 to 4 months late. That's pretty bad. And then you get up to the 5 and 6 months. And then if you go more than 6 months behind on your debts, they charge it off, write it off as a loss to the company. You will get a 1099 in the mail for the write-off, and then it goes to a collection agency. Well, they will continue to collect on the debt for the foreseeable future. So. Anyways, where was I? The highest since the first quarter of 2012. Additionally, auto loan delinquencies of 90-plus days rose by 4.43%, the highest since 2021. A New York Fed researcher highlighted that while consumers appear to be in a relatively stable position, the rising delinquency rates for auto and credit cards are concerning and warrant closer monitoring. Total household debt increased by $109 billion in the second quarter, a 0.6% rise, which is a deceleration from the 1.1% increase seen in the first quarter. About 3.2% of the outstanding debt was in some stage of delinquency, which remains lower than pre-pandemic levels. Homeowners are turning to HELOCs. Despite high mortgage rates limiting refinancing activity, consumers took out mortgages at a consistent pace with the previous year, and delinquency rates for mortgages stayed low. More homeowners turned to home equity loans, or HELOCs, to leverage their rising home values without risking their low mortgage rates secured in 2022 and before, when rates were at their lowest. HELOCs offer lower interest rates compared to credit cards and provide access to cash without needing for refinancing. Both new HELOC lines and draws from existing accounts increased in the second quarter of 2024, maintaining the highest levels since the first quarter of 2021. A New York Fed researcher also noted that the resurgence in HELOC usage marks a significant shift after a prolonged decline in popularity. This shift is attributed to the previously more appealing option of cashing out refinancing at lower rates, which is less attractive due to higher mortgage rates. So I guess, with people having higher delinquencies, what they should do is just use their homes as ATMs, since, there's it's probably the cheapest way for you to get your money out of or to use credit these days. So, all right, let's get that off the screen. And one last article here comes from our buddies over at First Trust. This is from Mr. Brian Westbury. And this economic research report is titled Monetary Policy is Out of Control. Just based on that title, cannot disagree much. The growth of bureaucracy worldwide has led to a proliferation of complex and often impenetrable rules. The Federal Reserve exemplifies this complexity. Initially, the Fed operated under a gold standard, but over time, it gradually moved away from its anchor. By 2008, the Fed had severed the connection between money supply and interest rates, creating confusion that is rarely acknowledged or explained by the Fed or the media. Financial markets sensed that the monetary policy was unhinged even before inflation hit a 40-year high. Gold prices and cryptocurrencies surged as central banks continued to abuse money. The complexity and opacity of the Federal Reserve's operations mean that few fully understand the implications of its actions. Historically, the U.S. monetary policy was anchored to gold, providing some discipline to the government. However, with the removal of the gold standard, allowed the Fed to print money without a corrective mechanism. This led to the Fed controlling the amount of reserves in the system, affecting interest rates and the money supply. A market-based mechanism existed for trading federal funds, which sent real signals about the supply and demand of money. The 2008 financial crisis prompted the Fed to shift from a scarce reserve model to an abundant reserve model. This change decoupled the money supply from interest rates, leading to government price fixing for the federal funds rate. The shift allowed the Fed to flood the banking system with deposits and reserves, paying banks to hold excess reserves and preventing hyperinflation. Since 2008, the Fed has grown its balance sheet significantly, with reserves now roughly 40% of deposits. The federal funds rate is now set by the Fed without a true market, leading to government-controlled interest rates. This has resulted in a lack of real market signals for supply and demand of money. The current situation with the Fed's abundant reserve policy has led to confusion and inefficiencies. The Fed is now paying private banks and entities over $200 billion per year in interest on excess reserves, leading to significant losses. So they're printing money out of thin air to pay interest to banks just for holding fake money in their reserves. So it's genius, I know. The Fed's actions during the COVID-19 pandemic, which increased the money supply by over 40%, resulted in the worst inflation in 40 years. This article advocates for a return to a scarce reserve model or even a gold or Bitcoin standard to prevent such inflationary policies. It argues that the Fed's current policy moves the U.S. closer to modern monetary theory, intertwining Fed and Treasury policies and risking the stability of the dollar's value. The need for a stable dollar and transparent monetary policy is emphasized to prevent further economic instability. So it's really comforting, with this vast bureaucracy and its opaque operations has managed to make the monetary system just a complete mess. It's so complex and confusing. They can't even explain it to smart people. Imagine what, your average voter who, thinks Trump or Harris is a good person. So, they definitely have no idea. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone out there has a wonderful evening and try to stay dry. Hope the Astros can manage to pull this out. They're top of the eighth, no outs, nobody on. 1 out, nobody on. So hope everyone out there has a great evening, and I shall talk to you again next time. Adios.